Hello everyone, welcome back to the channel. Credit card companies call you dead weight if you pay on time, and they deliberately make the minimum payment so small that you never get out of debt. Today I will explain how the machine works that turns your plastic into their trillions. Americans owe $1.233 trillion in credit card debt. This is a record in all of history. For comparison, this is more than the GDP of Mexico or Indonesia. The average household debt is about $9,300. The average interest rate is more than 23%. Do the math. At that rate, the debt doubles in 3 years if you pay only the minimum. And now the key point. 46% of cardholders carry a balance from month to month, almost half. And it is exactly these people that the industry makes its main money on. In 2020, credit card companies earned $176 billion in revenue. From interest alone, $76 billion. That is more than the annual budget of many countries. But the most interesting part is how this machine is actually designed. Because credit card companies make money from you even when you think you have beaten the system. Credit card companies make money in 3 main ways, and each of them is a small masterpiece of financial engineering. The first source is interest. This is 80% of all profit. $8 out of every 10 that a bank earns on credit cards are your interest payments. How does this work? You bought something for $1,000. If you pay it in full at the end of the month, the bank gets nothing from you. But if you leave even part of the debt, the magic of compound interest begins. At a rate of 23% per year, interest is calculated daily. That means every day your debt grows a little. And the next day, interest is calculated on a new, slightly larger amount. And so on, in a circle. If you owe $5,000 and pay only the minimum, you will pay about $1,000 to $1,250 in interest per year. Over 5 years, $5,000 to $6,000, that means you will give the bank as much as you originally borrowed. And maybe even more. The second source is fees from merchants. This is called the interchange fee, an exchange fee. Every time you swipe your card, the store pays the bank from 1% to 3% of the purchase amount. You bought coffee for $5. The store gave the bank 10 to 15 cents. You paid $100 for dinner. The bank received $2 to $3. Billions of transactions per year. Billions of dollars in revenue. And here is what matters. You do not pay this directly. But stores build these fees into prices. Studies show that prices in stores are higher by 1 to 3% precisely because of card fees. That means everyone pays, including those who pay in cash. The third source is penalties and charges. Late with a payment, a fine of $30 to $40. Went over the limit, another penalty. Took out cash, a fee plus a higher rate. Annual fee, from $0 to $795, depending on the prestige of the card. According to the Federal Reserve, penalties, especially late fees, make up about 15% of credit card profits. And now, the main dirty secret. Every month your statement has a number, the minimum payment. Usually this is 1 to 3% of the balance or a fixed amount. Whichever is higher, it looks harmless. I will pay the minimum and deal with it later. This is a trap, and it is designed deliberately. In the 1970s, the minimum payment was about 5% of the balance. Then banks began to lower it. Why? Because the smaller the minimum payment, the longer the customer stays in debt. And the longer the debt lasts, the more interest is paid. Let us calculate using a real example. You have a debt of $5,000. The rate is 18% per year. The minimum payment is 2% of the balance, or $25, whichever is higher. That means the first payment is $100. If you pay only the minimum, it will take you more than 30 years to pay off this debt. And you will pay more than $8,000 in interest, almost twice as much as you originally borrowed. At the same time, 80 to 90% of your minimum payment goes to interest. Only 10 to 20% goes toward reducing the principal. 1 step forward, 9 steps back. Today, 1 out of every 10 Americans can afford to pay only the minimum. This is a record, and banks know it. They count on it. Moreover, banks deliberately do not want you to pay off your debt. A customer who pays in full every month is called a deadbeat in the industry, literally dead weight, because no interest can be earned from them. The ideal customer for a bank is someone who is forever in debt, but always pays the minimum. Does not go bankrupt, does not close the card, but also does not get rid of the debt, a cash cow. Credit cards are not just a financial tool. They are a psychological weapon. Trap 1, the pain of paying. When you pay with cash, you physically feel the money leaving. This is called the pain of paying. When you pay with a card, that pain is gone. You just swipe the plastic or tap your phone, no feeling of loss. Studies show that people spend 12 to 18% more when they pay with a card rather than cash. And some studies show a 100% increase in spending, that is, twice as much. McDonald's found that the average bill paid with a card is $7, while with cash it is $4.50. The difference is more than 50%. Trap 2, rewards and cashback. Get 2% back on every purchase. Sounds great, right? But this is a psychological trick. First, to get this cash back, you have to spend. Banks know that loyalty programs increase spending. You spend more in order to earn more points. Second, if you pay interest even once, you lose all the cash back for years. At a rate of 23%, 1 month with a balance of $1,000 costs you almost $20 in interest. That eats up 2% cash back from $1,000 of purchases. Third, who pays for the cash back? Stores, through higher fees. And who pays the stores? All customers, through higher prices, including those who pay cash and get no cash back at all. Trap 3, status. The Black American Express card, the Platinum Visa, the Gold MasterCard. This is not just plastic. These are status symbols. Banks know that people are willing to pay $500 to $795 in annual fees for a card of a certain color, because that card tells the world, I am successful. And then a person with a prestigious card feels that they must live up to it. Eat at expensive restaurants, fly business class, buy things they cannot afford. Identity becomes tied to spending. I deserve this turns into, this purchase reflects who I am. And the debt grows. Late fees are a separate source of income, and banks do everything to make sure you pay them. The average late fee is about $30 to $40. Since 1992, it has more than doubled. Back then it was about $12. This growth is faster than inflation, but it is not only about the size of the fee. Banks have shortened the time between sending the bill and the payment due date. Less time means a higher chance you will be late. More late payments mean more fees. In the past, many banks offered a grace period, several days after the official due date when no penalty was charged. Now 2/3 of banks have eliminated it. Late by 1 day, a fee. And here's what is even worse. One late payment can trigger a penalty APR. This can be 29% instead of your usual 18%. And this rate can apply to your entire balance, not just the late payment, one missed payment, and your debt starts growing 1/3 faster. And a delay of more than 30 days goes on your credit report. This can lower your credit score by 50 to 100 points. And that damage stays on your record for 7 years. There are cards with no annual fee. There are cards with generous cash back. There are cards with sign-up bonuses. Where does the money come from? The first source is people who pay interest. 80% of profits come from people who carry balances. If you pay in full every month, you are being subsidized by those who are in debt. The second source is merchants. A fee on every transaction, 1 to 3%. That is hundreds of billions of dollars a year. Stores raise prices to cover these costs. The third source is people with poor credit. Cards for people with low credit scores have huge rates, up to 30 to 36% per year, and high fees. These customers pay the most. This creates a paradox. The poor subsidize the rich. People who are forced to borrow and pay interest finance the cashback for those who can afford to pay in full. People without cards pay higher prices that cover card fees. Studies show that cashback and rewards programs redistribute money from the poor to the rich. Low-income households pay more on average and receive less. This is not a bug. This is a feature. Now, practical advice. How to use cards without falling into traps. Rule 1, pay in full every month. This is the only way to use a card for free. If you pay interest even once, you lose. Rule 2, treat the card like cash. Before a purchase, ask yourself, would I pay for this with cash right now? If not, do not buy it. Rule 3, never pay only the minimum. If you cannot pay in full, pay the maximum you can. The difference is huge. With a $5,000 balance, an extra $50 a month above the minimum can cut years off repayment and save thousands in interest. Rule 4, set up autopay, but not for the minimum, for the full balance. This protects you from late fees and from the temptation to pay later. Rule 5, do not chase rewards. Cashback only works if you do not pay interest and do not spend more because of bonuses. If a loyalty program makes you spend more, you are losing. Rule 6, have an emergency fund. People go into debt when something unexpected happens. Car repairs, medical bills, job loss. If you have a cushion of 3 to 6 months of expenses, you do not need to borrow on cards.
Let's sum it up. Credit card companies are not charity. They are a profit extraction machine. $176 billion a year. $1,233 billion of debt. 23% per year. The minimum payment trap. Psychological tricks. Fees for everything. If you pay in full every month, banks call you a deadbeat because they cannot earn interest from you. If you carry a balance, you are the product. Your debt is their asset. Your interest is their profit. Your late payments are their bonus. A credit card can be a great tool if you know the rules of the game and do not let yourself be played. Free credit for 30 days, purchase protection, cash back, all of this is real if you are disciplined. But if you slip even once, the system starts working against you, and it is designed so that you will slip. $1,233 billion speak for themselves.